£9,200,000,000. Most people who get a letter from because HMRC, it's routine. They open it, read the first line, and then the room goes very quiet. Because HMRC doesn't investigate randomly. They have a system called Connect. And Connect already knows more about you than you think. Connect is HMRC's data matching system. It cross-references over 30 billion data points, your bank transactions, your land registry entries, companies' house filings, income from eBay, Airbnb and Etsy, your pay records, and yes, even social media where people have posted about cars and holidays that don't match their tax returns. If your declared income doesn't match what Connect sees, it flags you automatically. No human intervention required. This video explains exactly what those triggers are and what you can do before that letter ever arrives. Trigger 1. Undeclared cash income. If you work in trades, tutoring, childcare, or any cash-based service, and your bank deposits don't match your declared turnover, Connect flags it. It compares your lifestyle spending against your declared income automatically. Trigger 2. Undeclared rental income. Land registry knows what property you own. HMRC can see whether you're declaring rental income that matches it. Since 2023, letting platforms are legally required to report landlord earnings directly to HMRC. Trigger 3. Side income from platforms. E-sellers, freelancers, and anyone earning through PayPal, Etsy, Fiverr, or Airbnb. Those platforms now report your annual income to HMRC automatically. The threshold that used to protect small sellers has changed. Trigger 4. Director loans. If you run a limited company and took a director's loan that wasn't repaid within 9 months of your year end, HMRC will expect to see it declared. This is one of the most frequently missed triggers for small business owners. Trigger 5. Cryptocurrency. Crypto gains are subject to capital gains tax. HMRC has written to every major exchange operating in the UK requesting user data. If you sold, swapped, or gifted crypto, it needs to be declared, even if you made a loss. Trigger 6. Lifestyle doesn't match income. This is the Connect system at its most powerful. If you're declaring £30,000 a year, but your credit data, travel records, and consumer spending suggest you're living on twice that, Connect will flag the mismatch. Trigger 7. Late or amended tax returns. Filing late or amending a return after the deadline increases your investigation risk profile. It's not an automatic trigger, but it does move you up the priority list. So what actually happens when HMRC opens an investigation? First, they don't always tell you why. HMRC can open what's called a full inquiry or an aspect inquiry. A full inquiry covers your entire tax return. An aspect inquiry focuses on a specific area, usually the one that triggered the flag. The first letter you receive will be an inquiry notice under Section 9A of the Taxes Management Act. It will ask you to produce documents. You have the legal right to know which tax year is under investigation and what information they need, but not always the specific reason for the inquiry. Here's the critical point. You are not required to respond immediately. You have rights, but those rights have time limits. And ignoring HMRC makes things significantly worse. If you receive a Section 9A notice, the first thing you should do is not reply directly. Get a qualified accountant or tax advisor involved before you send a single word to HMRC. Now, what are the penalties if HMRC finds something? This depends almost entirely on one thing: whether the error was careless, deliberate, or concealed. Careless errors, things you should have known but missed, carry penalties of up to 30% of the tax owed. Deliberate errors, where HMRC can show you knew about the discrepancy, carry penalties of up to 70%. Deliberate and concealed, where you actively hid the error, can mean penalties of up to 100% plus potential criminal prosecution. The single most important factor in reducing penalties is what HMRC calls unprompted disclosure, coming forward before they contact you. The penalty reduction for voluntary disclosure is significant. We'll cover how to do that in a moment. A quick note on timing. HMRC can normally go back 4 years for a careless error, 6 years if the error was more significant. And in cases involving deliberate or fraudulent behaviour, there is no time limit. They can go back as far as they need to. Here's what you should do right now, before you ever receive that letter. Step 1. Run your own numbers. Go back through the last 3 tax years and check whether your declared income matches your actual bank deposits and platform earnings. This is the same exercise Connect runs automatically. Do it yourself first. Step 2. Check your property records. If you own rental property and haven't been declaring the income, or if you've sold property and aren't sure whether capital gains tax applied, check your land registry entries now. You can do this yourself at gov.uk for £3. Step 3. Review any director's loans. If you run a limited company, check your last 2 or 3 sets of accounts for any director's loan accounts. Anything outstanding beyond 9 months of your accounting year-end needs to have been handled. Step 4. Consider voluntary disclosure. If you find an error, even a historical one, voluntary disclosure to HMRC before they contact you reduces your penalty significantly. HMRC's contractual disclosure facility exists specifically for this. A qualified accountant can help you use it. Step 5. Get your records in order. HMRC can request up to 6 years of records during an investigation. Bank statements, invoices, receipts, contracts. If yours aren't organised, start now, not when the letter arrives. £9,200,000,000. Now you know what it means, and which side of that number you want to be on. If this video helped you understand the system, subscribe. The next video covers self-assessment mistakes that are still costing UK freelancers thousands every year. Things your accountant probably assumes you already know. I'll see you there.